Hello students, my name is Munawali and I am an ACCA professional level student. This lecture is on IAS 38 Intangible Assets. The objective of IAS 38 is to prescribe the accounting treatment for intangible assets that are not dealt with specifically in another IFRS. The standard requires an entity to recognize an intangible asset if and only if certain criteria are met. The standard also specifies how to measure the carrying amount of intangible assets and requires certain disclosures regarding intangible assets. Scope: IAS 38 applies to all intangible assets other than financial assets, exploration and evaluation assets, expenditure on the development and extraction of minerals, oil, natural gas and similar resources, intangible assets arising from insurance contract issued by insurance companies, intangible assets covered by another IFRS such as intangibles held for sale, deferred tax assets, lease assets, assets arising from employee benefits, and goodwill. Goodwill is covered by IFRS 3. Definition of intangible asset: an identifiable non-monetary asset without physical substance. An asset is a resource that is controlled by the entity as a result of past events and from which future economic benefits are expected. Thus, the three critical attributes of an intangible asset are identifiability, control, future economic benefits. Identifiability: an intangible asset is identifiable when it is separable, capable of being separated and sold, transferred, licensed, rented, or exchanged, either individually or together with a related contract, or arises from contractual or other legal rights, regardless of whether those rights are transferable or separable from the entity or from other rights and obligations. Examples of possible intangible assets include computer software, patents, copyrights, motion picture films, customer list, mortgage servicing rights, licenses, import quotas, franchises, customer and supplier relationships, marketing rights. Intangibles can be acquired by separate purchase, as part of a business combination, by a government grant, by exchange of assets, by self-creation. Recognition criteria: IAS 38 requires an entity to recognize an intangible asset, whether purchased or self-created, at cost if and only if it is probable that future economic benefits that are attributable to the asset will flow to the entity and the cost of the asset can be measured reliably. This requirement applies whether an intangible asset is acquired externally or generated internally. IAS 38 includes additional recognition criteria for internally generated intangible assets. The probability of future economic benefit must be based on reasonable and supportable assumption about conditions that will exist over the life of the asset. The probability recognition criteria is always considered to be satisfied for intangible assets that are acquired separately or in a business combination. If recognition criteria is not met, if an intangible item does not meet both the definition of and the criteria for recognition as an intangible asset, IAS 38 requires the expenditure on this item to be recognized as an expense when it is incurred. Business combinations: there is a presumption that the fair value and therefore the cost of an intangible asset acquired in a business combination can be measured reliably. An expenditure included in the cost of acquisition on an intangible item that does not meet both the definition of and recognition criteria for an intangible asset should form part of the amount attributed to the goodwill recognized at the acquisition date. Reinstatement: the standard also prohibits an entity from subsequently reinstating as an intangible asset at a later date an expenditure that was originally charged to expense. Initial recognition: research and development cost. Charge all research costs to expense. Development costs are capitalized only after technical and commercial feasibility of the asset for sale or use have been established. This means that the entity must intend and be able to complete the intangible asset and either use it or sell it and be able to demonstrate how the asset will generate future economic benefits. If an entity cannot distinguish the research phase of an internal project to create an intangible asset from the development phase, the entity treats the expenditure for that project as if it were incurred in the research phase only. Initial recognition in process research and development acquired in a business combination. A research and development project acquired in a business combination is recognized as an asset at cost, even if a component is research. Subsequent expenditure on the project is accounted for as any other research and development cost. Initial recognition. Brands, masthead, publishing titles, customer lists, and items similar in substance that are internally generated should not be recognized as assets. Initial recognition computer software. If it is purchased, it should be capitalized. Operating system for hardware including hardware costs. Internally developed, charged to expense until technologically feasibility, probable future benefits, intent, and ability to use or sell the software, resources to complete the software, and ability to measure cost. Amortization over useful life based on pattern of benefits. Straight line is the default. Initial recognition, certain other defined types of cost. The following item must be charged to expense when incurred. Internally generated goodwill, startup, pre-opening and pre-operating costs, training costs, advertising and promotional costs including mail order catalogs, relocation costs. For this purpose, when incurred means when the entity receives the related goods or services. If the entity has made a prepayment for the above items, then prepayment is recognized as an asset until the entity receives the related goods or services. Initial measurement. Intangible assets are initially measured at cost. Measurement subsequent to acquisition. Cost model and the revaluation model allowed. An entity must choose either the cost model or the revaluation model for each class of intangible asset. Cost model. After initial recognition, the benchmark treatment is that intangible assets should be carried at cost less any amortization and impairment losses. Revaluation model. Intangible asset may be carried at a revalued amount less any subsequent amortization and impairment losses, only if fair value can be determined by reference to an active market. Such active markets are expected to be uncommon for intangible assets. Examples where they might exist are production quotas, fishing licenses, taxi licenses. The revaluation model can only be adopted if fair value can be determined by reference to an active market. An active market is one where the products are homogeneous, there are willing buyers and sellers to be found at all times, and prices are available to the public. Under the revaluation model, revaluation increases are credited directly to revaluation surplus within equity except to the extent that it reverses a revaluation decrease previously recognized in profit and loss. If the revalued intangible has a finite life and is therefore being amortized, the revalued amount is amortized. Classification of intangible assets based on useful life. Intangible assets are classified as indefinite life, no foreseeable limit to the period over which the asset is expected to generate net cash inflows for the entity, finite life, a limited period of benefit to the entity. Measurement subsequent to acquisition, intangible asset with finite life. The cost less residual value of an intangible asset with a finite useful life should be amortized on a systematic basis over that life. The amortization method should reflect the patterns of benefit. If the pattern cannot be determined reliably, amortized with a straight line method. The amortization charge is recognized in profit or loss unless another IFRS requires that it to be included in cost of another asset. The amortization period should be reviewed at least annually. The asset should also be assessed for impairment in accordance with IAS 36. Measurement subsequent to acquisition. Intangible assets with indefinite life. An intangible asset with an indefinite useful life should not be amortized. Its useful life should be reviewed each reporting period to determine whether events and circumstances continue to support an indefinite useful life assessment for that asset. If they do not, the change in the useful life assessment from indefinite to finite should be accounted for as a change in accounting estimate. The asset should also be assessed for impairment in accordance with IAS 36. Subsequent expenditure. Subsequent expenditure on an intangible asset after its purchase or completion should be recognized as an expense when it is incurred, unless it is probable that the expenditure will enable the asset to generate future economic benefit in excess of its originally assessed standard of performance, and the expenditure can be measured and attributed to asset reliably. Disclosures. For each class of intangible assets, disclose useful life on amortization rate, amortization method, gross carrying amount, accumulated amortization and impairment losses, line items, in the income statement in which amortization is included, reconciliation of the carrying amount at the beginning and at the end of the period showing additions, assets held for sale, retirements and other disposals, revaluations, impairments, reversal of impairments, amortization, foreign exchange differences, other changes. Basis for determining that an intangible asset has an indefinite life, description and carrying amount of individually material intangible assets, certain special disclosure about intangible assets acquired by way of government grants, information about intangible assets whose title is restricted, contractual commitments to acquire intangible assets. Additional disclosure are required about intangible assets carried at revalued amount, the amount of research and development expenditure recognized as an expense in the current period. This lecture is presented by Munawar Karim Khan. He is an ACCA professional level student. This presentation includes extract from relevant IAS. If students have any problem in understanding IAS 38, kindly contact munawarali88@hotmail.com. Thank you, bye bye, and take care.